Hello everyone, I am Henry. Today we will be discussing the Hong Kong Certificate of Residence in detail. When Hong Kong-based companies begin establishing new branches in China or overseas, they may not realize they are already paying taxes in those places. Using Hong Kong and its 45 bilateral tax agreements to reduce taxes might be considered. However, to take advantage of the DTA between Hong Kong and other places, one must become a Hong Kong tax resident. What is a Hong Kong tax resident? The answer is that the management and day-to-day control of this company must be conducted in Hong Kong. If a Hong Kong company establishes a Chinese subsidiary, WFOE, it is natural to distribute dividends to Hong Kong when you make a profit. With a certificate, the withholding tax decreases to 5%. Another scenario is when a Hong Kong company has set up a representative office in China. A portion of the income will be taxed in both mainland China and Hong Kong. Therefore, you need to sign the tax credit in Hong Kong to avoid double taxation. Suppose a Hong Kong firm offers services to clients in India. When international clients remit service fees, they need to withhold a 15 to 25% tax as required in India. Certificate requires only 5 to 10% deduction. Finally, if a Hong Kong company wants to receive royalties from a Chinese company, royalties remitted from China will be subject to a 10% withholding tax. However, if there is a certificate, only 5 or 7% needs to be deducted. The places mentioned above are just one example of the many available options. Other regions that have officially signed a DTA agreement with Hong Kong may also apply. So how can you become a Hong Kong tax resident? At the top of this group is a publicly listed multinational company based in Taiwan. In the middle stands a Hong Kong-based company. At the bottom of the chart are two companies in mainland China. The reason why Hong Kong companies need this certificate is because domestic companies must distribute dividends to Hong Kong, reduce the withholding tax to 5%. The situation with a Hong Kong company is that the two directors are permanently residing in mainland China and Taiwan respectively, and board meetings are rarely held in Hong Kong. The employees do not work in Hong Kong and there is no official office in Hong Kong. I believe everyone has already guessed. Although this is a company established in Hong Kong, it is not a Hong Kong tax resident. If you want to become a Hong Kong tax resident, you must first fill out a form with the Hong Kong Inland Revenue Department. The Tax Bureau usually raises additional questions and requests more documents, and the entire process may take 2 to 3 months. Once you successfully obtain the certificate in Hong Kong, you can submit it to the foreign tax authorities to enjoy the benefits of the DTA. If you want to know more, do refer to the articles on our website. Goodbye.